I know that you're always interested in my price action pattern videos, so in this video I have 6 updated, new and improved price action patterns, and I'll show you exactly how to trade them. First, let's start with the liquidity run. So now let's see what we have here. We are starting here from a consolidation breakout. The market broke out of this resistance and then we trended higher. The market reached then kind of a double top. We might have had a little bit of a breakout that was then rejected. We have a lower bounce, and then here, this is what we are calling a pressure pattern, where the market is moving into a previous low and it's not able to pull away, but it's really sticking to this level. At that point in time, probably a lot of traders are looking for breakouts to the downside, and I think this would make a lot of sense looking for short scenarios here because of the failed continuation to the upside. The breakout happens here, and now think about how the average breakout trader will approach this chart. Most of the breakout traders who get in short here will have their stop loss in this stop zone, somewhere above the breakout level, maybe even all the way above this recent high. But somewhere in here there's going to be a lot of stops, and this is liquidity. What you will often see, not always but very often, is then a pullback into the stop zone. This is a great sign, and what I've done in my trading over the years is that I have stopped mostly trading breakouts, and I've been waiting for those stop and liquidity runs. Now when you see such a move back into the stop zone, what I'm waiting for is a clear sign of momentum away from the stop zone. I want to see that there is a lot of momentum to the downside. I want to see preferably some strong red candles that are telling me we have hit liquidity, we are moving away from this, and that the market is not able to fall back within the pattern, which could then look like a failed breakout to the downside if the market is able to move back within the pattern. Some traders may even choose to wait until the market is clearing the lowest low structure, which is here. And then you can see we get those strong red candles. Those are the signals that you're waiting for. You want to see that the market is really showing strength on the bearish side, such as here and here and here. And those red candles are clearly stronger and larger than the green candles that we are seeing. This is a very, very important observation that you can make in those scenarios. Then the market is closing here below the lowest low that we've seen previously. And then a lot of traders who specialize in those liquidity runs will then use those scenarios when the price is clearing the low as an entry signal. And you can see afterwards, the market has a very easy time to move lower. We could then, for example, start using the moving average, which is a 50 EMA moving average, to trail our stop loss and then hopefully catch a runner where you have a very large reward to risk ratio. Next is the breakout build-up. This is a great add-on pattern, and you will find this breakout build-up very often around other common price patterns. So now let's see how this looks like. What do we see here? Now let's start by dissecting this price chart together, and I think we can learn quite a bit about this. What we are seeing is that the market has topped out. Seemingly, we came here from an uptrend on the left side. We had a double top. We started to make lower highs. We broke out through this previous resistance level that was short-term support, and then we cleared this level. This is a great sign that we are now overall more in a bearish scenario. Whenever you see those strong breakouts out of a long-term accumulation or distribution pattern, those are great signals that the longer-term trend has also changed. We see the breakout to the downside, the market goes into the first consolidation, and this is really important to observe. How is the market behaving after this initial strong breakout, after the strong first impulsive wave? We see that the market is going into the sideways phase. We're getting this very nice, very precise support level here to the downside. The market is respecting this area down here. Then the market starts to make higher lows. And this is what we call the breakout buildup. It's a very subtle, it's a very small signal, but a very meaningful one. And whereas in the past, whenever the market hit this zone, it rallied quite a bit. You can see we hit the zone here, we rallied higher, we hit it here, rallied higher, hit it here, rallied higher. This time, we don't see that. There's no bullish reaction, and it shows us that at this point, the bulls are not as interested anymore in this price chart. And then this shows us that if we get the breakout, there could be a lot of force because the bullish side has completely withdrawn from the charts. And then we get the strong breakout candle. The stronger the breakout candle, the better the signal overall typically also is. And this is a great signal for another continuation. Here we have seen a strong breakout candle that led to the push. Now we're seeing another strong breakout candle. We have the right trend context because we're going here with the downtrend that we have already seen here previously getting started. And then you can see the market sold off. We had another consolidation here, strong breakout candle down here, and the continuation. We're getting another consolidation here, and we can just repeat the same and wait for the next signal. Next is the cup and handle, a really important trend continuation, also really important long-term chart pattern. What we see here is that the market has been a very strong uptrend, and then the market moves into this sideways period. And we can learn quite a lot about the price action when we are starting to analyze this phase here. First of all, we are in this long-term uptrend. Then the market here hit the double top. And after the double top, the market tried to sell off. At that point, I think a lot of traders were looking to short the market because they thought this longer term trend is ready to reverse to the downside. And if you've been paying attention, you can see that here the market also moved back inside of the pattern, just like it did on the liquidity run. However, the market never looked back. We never saw strong selling occur after the market hit potential stop zones up here. So this is a really different picture that we have seen. And here we don't see selling strength. What we're seeing is that the market is able to push all the way back into the high of the pattern, and then after it hit a high, it's not able to sell off like it did here. Here the market hit the level, sold off. Here it hit the level, didn't sell off a lot. So this is now a very different picture. We have the failed breakout, we are in the uptrend, and then we are suddenly seeing the market behaving maybe even like a little bit of a lower bounce. The breakout build up, the market is not able to get away from this resistance level. And then we have the breakout. Here we can now clearly observe the cup and handle. We have the big rounding part, which is the cup. And then here we have the breakout build-up, which is resembling the handle of the cup. Then we get the strong breakout. Again, a very strong breakout momentum sequence. We have a lot of green candles in a row. This is exactly what you want to look for. And this is often then the continuation signals that long traders are looking for. If you get an entry here, then typically you want to put your stop loss either all the way here below that, or maybe some traders also chose to put their stop loss below the breakout candle. Then you can see the continuation happened and the market continued the uptrend that we have already seen here previously. So this is a super important scenario because it can help you understand breakouts and fakeouts. We have the breakout, but then we don't get the liquidity run retest. The market is able to pull into the pattern and establish itself up here. We don't see selling return into this scenario. And because a lot of traders have problems with breakouts and fakeouts, this scenario and this example can help you understand, hopefully, how to trade breakouts and fakeouts a little bit more effectively. If you're looking for continuation trading, then flags are among the most important and the highest performing continuation patterns out there. So now let's again try to dissect this chart and let's see what we can find here. What we see is that the market has been in a clear uptrend. I activated here the weekly pivot points, and this is the central weekly pivot point. The market is well above the weekly pivot point, and then here, after the market has seemingly topped up and made lower highs here, the market moved back into the weekly pivot point. Weekly pivot point retests are really common during trending markets. And it's very important to observe and analyze how the market is reacting to those weekly pivot points that we are seeing in trending markets. So what we see is that the market is entering in this channel. The channel is going down. And as long as the market is inside this downward sloping channel, you have to be very careful because this is, for now, not a bullish signal. You have to wait until the market either completely clears the channel and then accelerates to the downside, or we are able to resume and make higher highs again and able to retest this pivot point, and then it's becoming support. Another important tip, here is the daily high-low indicator. I made videos about the daily high-low indicator. You just search for daily high and low on TradingView, and then you will get this indicator. In an uptrend, you will see that the market is typically staying around the daily high, which is the green channel. On a downtrend, you will see that the market is pushing into the daily low. And if the market is able to establish itself long-term like it did here, outside of the daily high, it's an uptrend. Here in this case, the market is not able to really get outside of the daily high, or the daily low in this case, to the downside, as it did here. So for now, this is a little bit of a weaker signal. And then we just continue following the market. Is the market able to stay outside of the daily low? Then you're most likely looking at a long-term reversal to the downside. However, if the market is rejecting daily lows and able to clear the highs and move back into the daily high, then there's a high chance that this was going to be a continuation. In this case, you can see we have two strong bullish candles. And now the picture looks really different because what we are seeing now, when we just analyze the different trending phases, here in the first phase, we have a very strong and very long uptrend. For multiple days, the market moved higher very strongly. Then we have this relief consolidation. For 3 days in a row, the market moved lower, but it didn't move lower a lot because the market was never able to really advance to the downside. So we have strong buying and weak selling. This is really important that you start to get into the habit of analyzing the different market periods. How strong are the bullish waves? How strong are the bearish waves? Which waves are stronger, which take longer? Where's the market moving most and where's the market moving faster? In this case, we can clearly see we have a lot of strength on the bullish side. We have more weakness on the bearish side. We get the breakout through the highs. The market is now trading into highs, and this shifts the probabilities to a continuation to the high side, to the upside in our favor. And as traders, we always want to play the probabilities. When the market was within the flag pattern, within the channel, the probabilities were not as great for a long continuation, so we want to wait. However, the probabilities and the outlook changes completely once we get those large momentum breakout candles. And then you can see afterwards, the previous trend structure was repeated exactly in the same fashion. We stay above the highs for a long period of time, we clear the highs daily and trade above them. Whereas here to the downside, the price was not able to really advance below the previous day low. This is such an important factor that I can't emphasize this enough. Pay attention to how the market is trading on the bullish side, on the bearish side. How is the market able to advance through daily highs and daily lows? And you will learn so much about the underlying price structure. Before we continue with the video, I want to show you my new trading program. I call it the Tradecademy. And this is the ultimate all-in-one trading education program. What you will find here is a completely new trading course. I've recorded over 80 videos with brand new trading content. The videos in this trading course have never been shared anywhere else before, and I go way deeper than in all of my YouTube videos. Also, you get mentored directly by me. I'm not using other teachers, I'm not using other coaches. I'm the one that you're always interacting with. There are live webinars taking place almost every week, and there's also a private community with other traders from all around the world, and also me. I'm interacting with all of my traders in the Tradecademy directly and personally. So you join the new video course, you get personally mentored by me, you have new trading strategies. They are completely brand new strategies. I've never shared the videos before. They are for swing trading, day trading, and for all the time frames. There's a great and supportive community. It works for Forex, commodities, cryptos, and also indices. Everything that I've learned mentoring traders for the last 8 years and having been trading myself for over 15 years is included in this course. There's also a certification program. So after you've gone through the course and you have learned the material, there are 60 trading questions waiting for you where you can prove your knowledge and then at the end get certified. So if you're interested, make sure to check the video link in the description below. If you have any questions, leave a comment. And if you decide to enroll, I look forward to welcoming you in the Tradecademy. Now let's take a look at a combined pattern where we have the trap component and we have the component of the inverse head and shoulders. So what will we see here? We have a downtrending market and the market is giving you this continuation to the downside. At that point in time, probably quite a few traders are jumping here on the short side, trade the continuations. In my eyes, there's probably nothing wrong with that. And it's very important to understand that not everything will work out. You are a continuation trader, you get your continuation signal, all you can do is follow the rules, follow your system, and if the trade doesn't work out, you cut the loss, you minimize the loss, and then you wait for the next signal. This is really important. We cannot predict 100% of the moves. However, we can go with the market flow, and if something changes, our analysis and our rationale can change. So what we see is that we have the downtrend, the market was into the consolidation, we got the strong breakout, maybe you take the breakout, and then the market falls back inside of the pattern. At that point, as I explained in the beginning of the video, you want to wait for liquidity runs. Do we get back strong selling, or is the market just fiddling and fading here along? A little bit later you can see this is where the market moved into the pattern. We don't get strong selling, we have 3 small red candles and then the market just moved sideways. This is not a very convincing picture that we are looking here at a valid liquidity run. And even worse, for the bearish side at least, afterwards the market started to make higher lows. And this is what we call an inverse head and shoulder. We have the left shoulder here with the lows, the head is the lowest point, and then the right shoulder is when the market is starting to make higher lows. And then we get the strong breakout candle. The strong breakout candle is also an engulfing candle where we engulf the last maybe 6, 7, 8 candles in a row So this is a really strong relief signal where the market is suddenly pushing up. It has completely pushed out the sellers from the market and only the buyers are left. There's so much buying interested here that we are able to clear the highs. Then you can see the market reversed. And very often you will see that once the market has pushed out all the sellers, you will often see those explosive moves. Especially after fake out trap patterns, this is a very, very common occurrence. And finally, let's take a look at another combination of a liquidity and a capitulation. Very interesting chart study as well. And we're looking here at a multi-time frame approach. What we see here on the daily time frame is a very important resistance area, right? We have multiple candles and multiple times where the market pushed into the same zone. Also, what is really important to understand and look for is candlestick wicks in those zones. Repeatedly, we have a lot of wicks here. This means there's probably a lot of interest. Traders are having a lot of open trades or a lot of open positions waiting here for the price. And every time we hit this zone, something is happening. And therefore, this is a really important zone to watch for. If we can get above this, and this is the concept of eating the wick, which you can find on YouTube when you look for it. It's a very interesting concept. If you're able to take out the wicks, then the market has a very, very high chance of continuing higher. However, the opposite is true. If the market is not able to take out the wicks and is clearing the lows, then there is a very good chance that we're seeing a push away because there's a lot of buying interest in the zone so far. And now you can see we have this very strong engulfing candle to the downside. We have maybe the 4th or 5th wick in a row, 1, 2, 3, 4, 5 wicks in a row, and then the market is capitulating for the first time on the higher time frame. At that point, we're going to go to the lower time frame and we see the next capitulation. We move back into the resistance, which is turning into support. We have the breakout. We have the liquidity run that we've seen in the beginning of this video. And then we have the strong selling. And this is the key here. And it's very different from what we have seen in the previous example of the inverse head and shoulder, where the market moved back inside of the pattern, but we have never seen such a strong selling again. And this is really the key on understanding breakouts and fakeouts. You want to really see that the market is giving you this strong pushes, where this shows you that one side of the market, in this case the bullish side, is completely pushed out of the market and the sellers are here in total control. The sellers are dominating the market, and at that point the continuation to the downside is way more likely. And you see that the market is almost vertically falling here after here the capitulation, the liquidity run, however you want to call it. There are many names floating around on the internet. It doesn't matter what you call it, it matters what it tells you about the market.